Hi, this is a PowerPoint video that explains the Federal Reserve, also known as the Fed. First, you need to understand how banks make money. So here we have you, the depositor, and you're going to deposit $1,000 in the bank. If the bank lends to Reliable Rob, here the bank is lending out your $1,000 to Reliable Rob. He's going to pay the bank back plus interest. So here it is. He's paying the $1,000 back plus $100 interest. The bank keeps some of that interest and it gives some of the interest back to you, the depositor. After all, the bank was lending out your money, and Reliable Rob pays back plus interest. If the bank lends to Shady Sam and he does not pay back, we call that defaulting. He defaults on the loan and doesn't pay it back. Then the bank is going to take his collateral. That's an asset like a car or a home, and the bank can then sell it and make money. So banks usually make money by lending. They either get paid back from Reliable Rob plus interest, or Shady Sam defaults, the bank takes the collateral and can sell it. So since banks usually make money by lending, do banks like to lend? Yes or no? Yes, banks like to lend. But what happens when banks lend too much money to too many Shady Sams? Some of them default, and then the bank has lost the depositor's money. Banks periodically in US history loaned out too much money to people like Shady Sam, and those loans were not paid back. So depositors lost money and banks stopped lending. So the US economy crashed. And this happened pretty regularly, almost every 20 years: 1789, 1819, 1837, 1857, 1873, 1893, 1907. Almost every 20 years, almost like clockwork. Here you can see it: 1857, 1873, 1893, 1907. So the US realized it needed a bank supervisor or bank babysitter, and that's where the Federal Reserve comes in. I'll come back to that in a second. Also, we want to avoid high inflation. Inflation is rising prices. Inflation makes our money worth more or worth less. If prices are going up, our money is worth less. And inflation leads to the wage price spiral, which is a bad thing. Let's start here with inflation. Let's say the price of our milk and our t shirts and our gasoline is going up. Then workers want higher wages, okay? And they demand higher wages. And so the companies pass those higher labor costs on to consumers. So, for example, if the price of gasoline goes up, the workers in the t shirt factory want higher wages, and the boss agrees to pay higher wages, and then the companies raise the price of t shirts to pay for the pay raise. And we get stuck on this wage price spiral. That's not good. Also, we want to have low unemployment. Why do we want low unemployment? We want people to have jobs. And if you look here at the unemployment rate going back to 1948, when the government started to keep the statistic, you can see what has happened to the unemployment rate. It's gone up and it's gone down. So, in 1913, the federal government and President Woodrow Wilson created the Federal Reserve, also known as the Fed. It has two goals. It wants to keep inflation low, down about 2%, and it wants to keep unemployment low. And also, the Fed supervises banks. The Fed is kind of sort of part of the government and kind of sort of not part of the government. At the top of the Fed is the Board of Governors. They're what we call an independent government agency, kind of in the government, kind of not. And this is what the Board of Governors looks like in 2022. And slowly we're making progress. We have a more diverse Board of Governors that reflects the diversity in the US population. The Board of Governors gets no money from the Congress. The Fed basically pays for and funds itself. But Congress does oversee this Board of Governors. The Board of Governors meets at the Fed's headquarters in Washington, D.C. Under the Board of Governors are the regional Federal Reserve banks. We have basically 12 different regions. Boston is the headquarters for the New England region. Atlanta is the headquarters for the Southeast region. San Francisco is the headquarters for the West region. And here you see there are roughly 12 regional Federal Reserve banks. They are set up like private corporations. The member banks that you and I use, like Needham Bank, Sovereign Bank, Citizens Bank, Santander, Bank of America, those member banks hold stock in the Federal Reserve banks, and each one has a local board of directors made up of 7 to 9 individuals from different places and different industries, like local banks, local restaurants, local companies. Why do you want people from different places and different industries on the local board of directors? It's to get a variety of viewpoints and to have the different parts of the economy represented. Maybe the restaurant industry, the hotel industry, the electricity companies, whatever. So there are 12 regional Federal Reserve banks. Here you can see their headquarters in Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, etc. Here is the Federal Reserve Bank in Boston. It's downtown by the aquarium. And if you look at the doorway here, it says Federal Reserve Bank of Boston. These regional Federal Reserve banks distribute the nation's currency. For example, look at a paper bill. If you look at the gray side of your paper bill, you can see the emblem or symbol of the Federal Reserve System. And at the very top, it says Federal Reserve Note. And if you look here, you can see which Federal Reserve Bank issued this note. So this is 12L. 12L. That's the Federal Reserve Bank out in San Francisco. I'll give you another example. This bill here says K11. So it came from where? K11, it came from the Dallas Fed, okay, in the South region there, okay? And Boston up here is 1A. That's the New England region. The Fed uses 6 tools to do its job, which is A, keep inflation low, B, keep unemployment low, and C, supervise banks. Here are the 6 tools. The Fed adjusts the reserve requirement ratio, known as the RRR. The Fed adjusts the interest on reserves that it offers to banks. The Fed adjusts the discount rate it charges banks. 4, the Fed's open market committee buys and sells government bonds to and from banks. And 5, the Fed does quantitative easing. Last, the Fed adjusts the overnight reverse repurchase rate. I will now explain each of these 6 tools. Number 1, the Fed adjusts the reserve requirement ratio. So the Fed makes banks keep some money in reserve. In the old days, it was in the vault, in the basement. These days, of course, it's all electronic, it's all on computer. The Fed says that the bank cannot lend that money out. For example, the Fed might say, Needham Bank, you must keep 5% RRR. You must keep a 5% reserve ratio. So you can lend out $95, but you must keep $5 in reserve, right? 5%, $5 is 5% of 100. You can lend out 95, you got to keep $5 in reserve. If we have a hot economy and we're running the risk of inflation, the Fed might raise the RRR to, let's say, 8%. Now, Needham Bank can lend $92 out, but they must keep $8 in reserve. So before they could lend out $95, now they can only lend out $92. There's less lending. In other words, people are going to get fewer car loans and fewer home loans. And if they don't get a home loan, they're not going to get a house. They're not going to get a sofa. They're not going to get a rug or a lamp or a refrigerator or a carpet. And so there's going to be less spending. And so the economy is going to cool off. If it's a cold economy and lots of people have lost their jobs or we're running the risk of deflation, then the Fed might lower the RRR to, let's say, 3%. In that case, Needham Bank can lend out $97, right? It's up from 95, it's $97, but they must keep $3 in reserve. So they can lend out almost all their money. There's going to be more lending, more car loans, more home loans, more spending, and the economy is going to heat up. The second tool, the Fed can adjust the interest on reserves that it offers to banks. Let me explain. If a bank saves some of its money, we call that reserves. If the bank saves some of its reserves at the Fed will pay the bank some interest on those reserves. It's just like when you save money at the bank pays you interest. In a hot economy, the Fed raises the interest rate on reserves. So they're going to pay the bank a higher interest rate. That incentivizes or encourages the bank to save more money at the Fed and lend out less money to the Smith family or the Wilson family or the Rogers family. There's going to be less lending, fewer car loans, fewer home loans, and so the economy is going to cool off. If we have a cold economy and nobody's spending, unemployment's high, we're running the risk of deflation, the Fed is going to lower the interest on reserves. It's not going to pay the banks that much interest. That's going to incentivize the bank to save less money at the Fed and lend more money out to the Thompson family or the Wilson family. So there'll be more lending, more car loans, more home loans. There's going to be more lending, more borrowing, so more spending, and the economy is going to heat up. The third tool is the Fed can adjust the discount rate. The discount rate is the interest rate it charges banks. For example, let's say here's the Fed, and they're going to lend to a bank $100 at 2% interest. This 2% is the discount rate. The bank then lends to us $100 at 4% interest. So we have to pay back $100 plus 4% interest, $4 interest. We pay back $104. The bank then has to pay back the Fed $100 plus $2 interest, or $102. So the bank is taking in 104 and paying out 102. The bank's profit is $2, or 2% of 100. If we have a hot economy and we're running the risk of inflation, the Fed is going to raise the discount rate from 2% to 4%, and it lends to the bank. The bank is going to then lend to us at a higher interest rate, let's say 6%. And we might say, ooh, 6%, that's high. I don't want to take out a car loan. I don't want to take out a home loan at 6%. That's too expensive. So there's going to be less lending, less borrowing, less spending, and the economy is going to cool down. In this case, we would pay back $100 plus $6 interest. We would pay back 106. The bank then has to pay back the Fed $100 plus $4 interest. That's 104 total. So the bank's taking in 106 and paying out 104. Again, the profit is $2, and the bank has maintained its $2 profit margin, 2% profit margin. Let's say it's a cold economy. Nobody's spending. Unemployment's high, and we're running the risk of deflation. The Fed now is going to lower the discount rate from, say, 2% to 1%. It's going to lend money to the bank nice and cheaply so that the bank lends to us at a cheap, low interest rate of 3%. We're excited to take out a car loan or home loan at 3%. So we're going to borrow. There's going to be more lending, and so more spending, and the economy is going to heat up. We need to pay back that loan, $100 plus $3 interest. So $103 goes to the bank. The bank pays back the Fed $100 plus $1 interest, 101 total. The bank's taking in 103, paying out 101. And again, the bank has maintained its $2 profit margin, its 2% profit margin. By the way, it is the Board of Governors that determines the RRR and how much banks must keep in reserve, and the Board of Governors determines the discount rate. This is what a Board of Governors meeting looks like in Washington, D.C. The Fed's fourth tool is the following. The Fed's Open Market Committee, the FOMC, meets. This is what it looks like. And they're going to buy or sell government bonds to or from banks. Again, they're going to buy or sell government bonds to or from banks. What the heck is a bond? Let me explain. A bond is an IOU. It's basically a loan contract. For example, Mr. Shotland says, I forgot my money for lunch today on Tuesday. Can you please lend me $5? And you, the student, say, sure, Mr. Unreliable. I'll lend you $5. Will you pay me back $5 plus $1 on interest? Okay? I say, yes, we have a deal. I'll pay you $5 back plus $1 interest. And you, the student, say, Mr. Unreliable, first we need to make a contract that says you're borrowing $5 and you're going to pay me back $6, right? $5 plus $1 interest is $6. So that loan contract is called a bond because the borrower, Mr. Shotland, is bonded or bound, obligated, required to pay back the lender. And so this would be a very simple bond contract. I, Joey Shotland, borrowed $5 on Tuesday. I'll pay back Chris $5 plus $1 interest on Friday. Investors like owning bonds because when you hold the bond, you're going to get interest, right? Chris is going to get his $5 or her $5 back plus $1 interest. Here is a real example of a U.S. federal government bond. If you buy this bond, you're lending the U.S. federal government $1,000. You see it here. This is a $1,000 bond, and it's a 30-year loan, all right, from 1977 till 2007. The U.S. government is going to pay you back $1,000 plus this 7.58% interest rate, all right? So that's going to be about $75.80 interest each year. So when you buy a bond, you're the lender. The government is borrowing money from you. They're going to pay you back $1,000 plus 7.58% annual interest. So going back to the FOMC, it is this part of the Fed right here. When the economy is hot, the Federal Open Market Committee is going to sell government bonds to the banks, and the banks are going to buy government bonds. Why are the banks happy to buy these bonds? Because if the banks hold the bonds, they're going to get paid back plus interest. So the banks buy the bonds, and you pay for bonds just like you buy food or buy clothes. You pay for it with money. So the banks are paying money. In other words, the banks are paying money to the FOMC, so the banks have less money to lend out. Lending goes down. There will be fewer car and home loans, and the economy is going to cool off. If we have a cold economy and a lot of people do not have jobs and nobody's spending, and we're worried about deflation, the FOMC is going to do the opposite. They're going to buy government bonds. Just like you buy carrots or you buy Kleenex, you buy that with money. So the FOMC is going to give money to the banks in exchange for the government bonds. Since the FOMC is buying these government bonds, it's giving money to the banks, so the banks have more money to lend out to the Wilson family or the Johnson family. Lending's going to go up. People are going to get a car loan and a home loan. They're going to spend more, and the economy is going to heat up. Fifth, the Fed does what we call quantitative easing. Quantitative easing. That's when the Fed buys long-term government bonds and some other assets. So when the Fed here gives money to the banks have more money, and so it's going to be easier to get a loan, and the economy is going to heat up. In other words, the Fed is buying bonds from the banks. The Fed is giving money here to the banks. In other words, the Fed is easing or increasing the quantity of money out there. And here you can see over the last 20 years or so, the Fed has been doing a lot of quantitative easing. The Fed's been giving money to the banks in exchange for bonds and other assets, and that gives the banks money to lend out to you and me. Quantitative easing heats up the economy. Last, the Fed's sixth tool. The Fed adjusts the overnight reverse repurchase rate. That's a lot, and it's a little complex. Let me explain. On day one, you have a bank that you and I might use: Citizens Bank, Sovereign Bank, Santander, Bank of America, Needham Bank, Rockland Bank, whatever. If they have some surplus or extra cash, they can put that money at the Fed. The Fed is the United States' central bank. In exchange, the Fed is going to give the bank some bonds. All right, so the bank's got extra cash, it parks it at the Fed, and the Fed gives the bank some bonds. Literally the next day, that's why it's called an overnight reverse repurchase agreement. Literally the next day, day two, the reverse happens. The central bank, that is the Fed, is going to give money back to the bank, and the bank's going to give back the bonds. Why the heck would you undo what you did the day before? Why do you reverse it the next day? Because the Fed is going to give the banks a little bit of interest, a little bit of extra money, and that's called the repo rate, the repurchase rate. Okay? So when the Fed lowers that interest rate, let me start up here. When the Fed raises that overnight interest rate, it incentivizes the bank to save more at the Fed. The bank is going to park more money at the Fed, and then the next day it's going to get that money back plus that higher rate of repo interest. It incentivizes the bank to park more money at the Fed, so the bank lends less out to the people, so there's less lending, so the economy cools off. If the Fed lowers this overnight reverse repurchase rate, it incentivizes the bank to save or park less money at the Fed and lend out more money to the people. So there's going to be more lending, and the economy is going to heat up. All right. What is the point of these overnight reverse repos? Again, aren't you just undoing what you did the day before? Yes, but it's another tool that the Fed has to move money out of or into circulation, and it can help the Fed keep the interest rate where the Fed wants it to be. And also, these overnight reverse repos affect the short term interest rate. So, to summarize and wrap up, if the economy is too hot, it's actually too strong, and we're running the risk of inflation and prices going up, the Fed wants to do what we call contractionary or tight monetary policy to cool off the economy. So the Fed's going to raise the RRR and make banks keep more in reserve. The Fed's going to raise the interest rate on reserves, which encourages or incentivizes the bank to keep more money in reserve at the Fed. The Fed's going to raise the discount rate and lend money to the banks at a higher interest rate. The FOMC is going to sell government bonds to banks in exchange for money and sort of suck money out of circulation. And the Fed could raise the overnight reverse repurchase rate. Again, that incentivizes banks to park more money at the Fed. This contractionary tight monetary policy is like hitting the brakes or turning down the thermostat or putting cold water on the fire. It's going to cool off the economy. On the other hand, if the economy is cold and weak and we're worried about deflation, then the Fed wants to do what we call expansionary or loose monetary policy to heat up the economy. In this case, the Fed is going to lower the RRR, and so banks can keep less in reserve and lend more out. The Fed will lower the interest on reserves. Now there is less of an incentive to keep the bank's reserves at the Fed. The bank is going to lend that money out. The Fed will lower the discount rate and make cheap loans to the bank so the bank can make cheap loans to us. And the Federal Open Market Committee is going to buy government bonds from the banks and thereby inject money into the banks, and the banks will then do more lending to us. The Fed could also lower the overnight reverse repurchase rate, so there's less of an incentive for the bank to put money at the Fed. The bank's going to lend money out to you and me. The Fed could also do quantitative easing, in other words, buy these long-term bonds and other assets, and thus give money to the banks, and the banks will lend to us. These measures are like stepping on the gas or turning up the thermostat or pouring gasoline on the fire. Do you have any questions? If yes, please ask. Thank you.